This video is sponsored by Finimize. In this day and age, we all know that we should be working smarter, getting our money to work for us. But if you're anything like me, that seems like a lot of time and a pretty long-term commitment. So how can we keep up with what's happening in the world of investing? Or more basically, where do you start if you're completely new to the world of investing? Well, this video is sponsored by Finimize, and they can really help you with that. Finimize is an app that was designed particularly with young, busy people in mind. The idea is to give you the information and tools you need to invest with confidence, and eventually empower you to become your own financial advisor. We've been playing around with it for a couple of days, so let me just share a few of the features with you. So, as you'd expect, they have the financial news packaged in the daily brief. Here you have options of text or audio summaries that you can easily digest on your commute or whilst you're walking the dog. But when you want to go deeper, they also have these 100 plus packs. I know that research was often a stumbling block for me. It's just so time consuming. But with these packs, you really get a comprehensive outline of top industries or companies that you may be looking at. Another thing I liked was the chat function, where you can ask questions to others in the Finimize community, and once you find your feet, there are Q&A sessions with investing pros and analysts too. In a nutshell, Finimize brings the biggest financial news and professional insights to young investors in language people actually understand. That demystifying approach carries over into the user experience as well. I found their design really good and uncluttered. Overall, it's a great tool for providing easy to digest investing knowledge. Click on the link in the description to set yourself up with the free 7-day trial, so you can see for yourself. And remember that you can cancel any time, even within the completely free 7-day trial. And if you do want to subscribe, all VisualPolitik viewers will also get a 20% off the premium yearly subscription. So check it out, Finimize. And now, let's get into our video. The SARS coronavirus 2 pandemic is having a strong impact on economies around the world, and therefore, that impact is also taking its toll on the productive fabric. To a greater or lesser extent, the vast majority of companies are experiencing a more than considerable negative impact, decreased sales, lower margins, and a collapse in profits. In fact, the rate of business failures is the fastest since 2013. In the old continent alone, the European Commission has calculated that the cost of the pandemic to businesses could exceed 700 billion euros just for 2020. Don't think that on the other side of the pond, the situation is different. Not at all. Without looking too far, we have the case of the car rental company Hertz, a company that did not sustain the onslaught of the coronavirus and had to declare bankruptcy. Of course, let's take a moment, because their problems were not exclusively due to the direct hit of the coronavirus. What happened was that the company simply could not escape a huge pile of debt of over $17 billion. And of course, it is by no means the only example that we can find. In fact, corporate debt is becoming a major concern, a concern that has led the United States government itself, together with the Federal Reserve, to intervene massively in 2020 to ensure the liquidity of the productive fabric. To give you an idea, among other measures, the US federal government put on the table a $500 billion small business loan program at the same time that the Federal Reserve announced its intention to buy $750 billion of corporate debt. Of course, in addition to the risk of public outcry that this may pose, this strategy offers no solution that goes beyond the most immediate problems. After all, in the medium term, it seems difficult to think that more debt is in itself a solution for companies whose problem was excess debt in the first place.
Many companies face solvency risks that are not corrected through debt. Over-indebtedness cannot be cured by more debt, no matter how cheap it is. Excerpt from an August 2020 report by Braven Howard Hedge Fund.
We are talking about an aftermath to the pandemic that could cause many, many problems in the future. Will this be the next crisis we face? Take note, because many analysts share this concern, such as Bill Ackman, the well-known founder and manager of Pershing Square Capital Management. After preempting the coronavirus in March and reaping a profit of $2.6 billion with an operation that involved paying a premium of just $27 million in insurance policies against default, he has set his focus squarely on corporate debt.
Ackman places new bet against corporate credit.
Today, in this new video made in collaboration with our friends from a value school, we give you all the details. Listen up.
A huge stock of debt.
At the end of October 2019, the International Monetary Fund issued a strong warning. If no action was taken, urgent measures would risk a new financial crisis in the business sector, a new crisis that could, in turn, spread to the banking sector. Thus, according to the IMF itself, nearly $19 trillion of corporate debt, most of it owned by US companies, could be vulnerable in the event of a material slowdown in the economy. Yes, it is true that over the last few years, debt has been cheap, that there is a lot of liquidity in the markets, and also that interest, unlike dividends, is deductible. However, crises often have the capacity to make debt radioactive. When income collapses, interest begins to weigh more and more heavily on the income statement, and obviously, those due dates become a nightmare. And this is precisely what led the IMF to issue that harsh warning at the end of 2019, back before the coronavirus pandemic hit the world economy hard. And friends, obviously the business closures, lockdowns, and quarantines have caused many companies' revenues and results to plummet. This in turn has forced them to run to the market for more debt to ensure liquidity. Look at what is happening with the debt of companies, large, medium, and small, in the United States. To give you an idea, Michael Hartnett, chief investment strategist at Bank of America, has estimated that $2.5 trillion in corporate bonds will be issued in the United States alone during the year 2020. That's trillions with a capital T. 2.5 trillion. It is a figure that is equivalent, for example, to practically all the annual production of the British economy, or almost twice the value of the Spanish economy. And that is not all. If we also take into account the relationship between net debt, that is, debt minus cash, and EBITDA, profit before interest, taxes, depreciations, and amortization, US companies have the highest financial leverage in decades. And keep one thing in mind. As much as both the US government and the Federal Reserve have intervened to ensure liquidity, it may not do much good in the medium term. An excess of debt usually ends up causing growth problems and even greater risks of crisis.
This cycle is very different because we have a lot of support from central banks and we have a lot of liquidity in the market. But the old saying, liquidity does not equal solvency, is something that people need to keep in mind when they are investing.
But I think that before we continue examining how things currently are and what it could all mean, we need to take a look at how and when this whole culture of debt, of unrestrained debt, was set in motion. Where did it all begin? Listen up.
The new culture of financial engineering.
This story may have originated in the 80s, a decade known among other things for the Reagan wave, the music of Michael Jackson and Queen, big hair, pastels, and films like E.T., Back to the Future, and The Empire Strikes Back. A decade that also had another very special characteristic, the large-scale takeoff of financial engineering, a process that had three main players. On the one hand, Professors Franco Modigliani and Merton Miller, who would go on to be the winners of the Nobel Prize in Economics. Two professors who presented a work that changed the landscape of financial culture. It was the well-known M&M theorem by Modigliani and Miller. You see, up until that point, the idea that depending too much on debt was an element of weakness and risk for companies had always been widely accepted, something that therefore diminished a company's value. However, the work of these two professors affirmed the opposite. The Modigliani-Miller theorem states that the market value of companies has to do with their ability to make a profit and the market risk of their underlying assets, and not with the manner in which they are financed. And not only that, since interest, unlike dividends, is deductible and therefore allows for less tax to be paid, suddenly debt is no longer seen as a risk, but as a means to add value. In other words, not resorting to high levels of debt could have a very high opportunity cost. Well, the fact is that this theory had an enormous impact on both the academic and business worlds, and when interest rates began to fall, many executives followed these guidelines to the letter. They stepped on the accelerator and began to take on much more debt than had previously been the case. But wait a minute, because along with these two professors, we have had to add the name of a third key player, Michael Milken, a young bond salesman who reinvented the function of the market and became popularly known as the king of junk bonds. You see, as the head of the bond department at Drexel Burnham Lambert, Michael Milken promoted the idea that investing in low credit rated companies' debt in exchange for high interest rates could be a very profitable investment alternative. So in order to encourage that activity, he led the creation of a specific secondary market for issuers of these type of bonds, popularly known as junk bonds. In this way, for every bond traded in this market, the firm Drexel Burnham Lambert pocketed a generous premium, which made it one of the most profitable corporations on Wall Street in the 80s. We are talking about a market that was valued at more than $200 billion at the time. Companies with problems, or medium and small businesses, found in this procedure a huge source of funding. And then what had to happen happened. Issues of this particular type of low-rated debt increased 25-fold, from just over $1 billion a year in the early 1980s to levels above $25 billion a year. Of course, in the last 2 decades, this kind of new debt culture has been joined by another key intervention, that of the central banks. Friends, since the beginning of the new century, in order to face first the dot-com crisis, then the financial crisis, and later to stimulate economic growth, central banks have squashed interest rates to almost 0% levels. Look, for example, at how the rates set by the Federal Reserve have evolved. And that's not all. Since 2008, and more particularly in 2020, the central banks have implemented another type of strategy known as quantitative easing policies, a strategy consisting of creating new money and using it to buy hundreds and hundreds of billions of dollars in debt assets, mainly public debt, but also private. This goes some way to explaining why, since 2008, the monetary base of the United States has multiplied by more than 5, going from about $840 billion to more than $4.7 trillion, and the rest of the big central banks, including the European Central Bank, have done practically the same thing. Friends, this policy is precisely what explains news headlines like this.
Pandemic sends real yields on corporate debt into negative territory. Low interest rates and monetary stimulus drag down yields of high-quality bonds.
So, launched with such a scenario, how can we not launch ourselves into devouring more and more debt? Well, the result of this entire new culture is obvious. While 4 decades ago, almost 70% of all companies rated by Standard and Poor's had a rating above A. Today, those companies represent less than 14% of the total. In fact, at the global level, there are currently more companies qualified with a speculative grade than with an investment grade. That is to say, those with at least a BBB rating. But that said, the burning question is, what exactly is the situation we are facing? Well, let's take a look.
A tidal wave of debt.
The combined debt of US companies not only exceeds $17 trillion, but also has an increasingly poorer rating. That is to say, everything indicates that the debt weighs more and more heavily, and that's in spite of the fact that interest rates are going down. Even among companies that do receive an investment rating, the largest issuances of debt correspond to companies with a BBB rating. That is, companies that are only one step above what is considered to be a speculative grade, very close to what many would call junk bonds. To give you an idea, Ruchir Sharma, Chief Global Strategist at Morgan Stanley Investment Management, estimates that 1 in 6 US companies does not generate enough cash flow to cover the interest payments on its debt. 1 out of 6 companies. Therefore, we are talking about companies that are very exposed to any financial problem that dries up markets and prevents them from attracting new financing. They are what is known as zombie companies. Companies so indebted that they barely have any margin to invest, transform, or resist the tide if the market becomes difficult. Then, as if that were not enough, there is another problem. Low interest rates are driving investors to take more and more risk in their portfolios to try to generate higher returns. So, what we find, therefore, is a progressive deterioration of the quality of many portfolios, whilst US companies are increasingly burdened with debt. And it doesn't matter if we look at investment grade or speculative grade companies. The balance sheets are increasingly loaded with debt, and their ratio to the EBITDA generated is growing. view of this, you should be careful when investing if you don't want to run the risk of having a very unpleasant surprise in the next few years. Over the past few years, we have seen many companies pay dividends and buy back shares using more and more debt, and now the coronavirus may end up turning everything upside down. Just to give you an idea, over the next 4 years, US companies will need to refinance more than $1.5 trillion in high-yield bonds, many of them junk bonds. Anyway, there you have it. This is the situation creating what many analysts consider the biggest risk ingredient for a future crisis on Wall Street. But what do you think? Do you think that this model is sustainable? Or do you think that this immense accumulation of debt will lead us to a new financial crisis instead? Will Wall Street be building its castle on a foundation of sand? Leave your answers in the comments. So I really hope you enjoyed this video. Please hit like if you did, and don't forget to subscribe for brand new videos. Don't forget to check out our friends at the Reconsider Media podcast. They provided the vocals in this episode that weren't mine. Also, this channel is possible because of Patreon and our patrons on that platform. So please consider joining them and supporting our mission of providing independent political coverage. And as always, I'll see you in the next video.
And if you want to learn more about politics and hear even more of my lovely voice, you can join us at Reconsider Media. We have a podcast at reconsidermedia.com/podcast. See you there.